Debits and credits, a quick tutorial guide. This quick tutorial provides an overview of debit and credit accounting, a fundamental concept in finance and accounting. We'll explain the basic principles and how they work in practice. What are debits and credits? Debits. Debits represent increases in assets or expenses. They can also represent decreases in liabilities, equity, and revenue. It's a crucial aspect of double-entry bookkeeping, a fundamental accounting method businesses use to record and track financial transactions. Credits. Credits represent increases in liabilities, equity, and revenue. They can also represent decreases in assets and expenses. The concept of credits and debits ensures that the accounting equation, assets equal liabilities plus equity, remains balanced. The rules of debits and credits. Assets, debit to increase, credit to decrease. Liabilities, credit to increase, debit to decrease. Equity, credit to increase, debit to decrease. Revenue, credit to increase, debit to decrease. Expenses, debit to increase, credit to decrease. How to apply debits and credits. Cash received, increase in assets, cash, so debit. Sales on account, increase in revenue, so credit. Paid utilities, decrease in assets, cash, so credit. Increase in expenses, so debit. Loan received, increase in liabilities, so credit. Increase in assets, cash, so debit. Practice examples. Basic entry, record a purchase of supplies for cash. Sales revenue, record a sale of goods on credit. Expenses, record the payment of rent. Many of you have inquired about the artificial intelligence, AI, software applications we are using. Please visit our website to see the current tools we utilize for content creation and text-to-speech (TTS). Disclaimer, these links are affiliate accounts.